Let's look at the big picture now for financial markets. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So let's go through some of the key markets. One of the interesting things that's happening right now is that there is this stealth assassination happening here from the bears. So if you go here to sectors and just go through them all. So here are like basic materials, and here you can see the distance from the 52-week highs, and of course the lows. And you see here that quite a few of these sectors are in bear markets. Uranium recently entered bear market. Global metals and mining bear market. And bear market is defined as a minus 20% pullback from the highs. Here as well, consumer cyclicals. You see that we have a bunch of bear markets. Then we go to financial services, looking a bit better, but here all of a sudden we have some bear markets happening here, like mobile payments. Then we go to real estate, consumer defensive. Then we go here to healthcare. You see here that this one is pretty close to bear market territory. Healthcare services, not that far away either. Utilities looking, decent. Communication services, here we have, social media, minus 32% from the highs, so that's definitively in bear market territory. Energy, looking pretty nasty. The hydrogen ETF is very close to a minus 20%, so that one is also a bear market candidate. Then you have the industrials. Then you have tech. Quite a few, that are in bear market. Okay, so the key thing is that even though this is happening, when we look here at, the major indexes, as an example, the S&P 500, which is, the key one people look at, it is only minus 4% away from the 52-week highs. So that one is very far away from, entering a bear market. So here we have, the S&P 500 weekly data points. And, the key thing is that we are testing, this super important moving average, the 20-week moving average. It has been, a key support level throughout this entire rally, post, the lockdown plunge. So we tested it here, and, we haven't broken it yet. If we were to break it, that would be quite significant. When we jump here to the daily data points, the key moving average here is definitively this blue 100-day moving average. Super, super, super important. And we are testing it now. The danger here is that, even though we went all down here to test it on Friday, here you see we went down. So the bulls were able to buy. And then, the bulls tried to get more ambitious, but you see that there was this pullback. So there is this pretty clear war here between the bulls and, the bears here on the S&P. But those are definitively some of the key levels to watch. Another market to look at is definitively the bond market. So here we have, the 20-year Treasury bond ETF, the TLT. And this one, it's been on quite an impressive rally here, because we did have this very clear head and shoulders pattern. But this recent rally here, it hasn't fully neutralized the head and shoulders pattern, but this is a very strong move, and it doesn't take that much more until the head and shoulder basically loses its validity. If we look here at the short-term correlation with the S&P 500 and the TLT, it is actually positive at the moment at 69%, and long-term it is 19-ish%. So yes, there is like a general thing in the sense that they do sort of move opposite each other. Statistically speaking, it's not really fully the case, as we saw with the correlations. It wasn't like strongly negative. But the basic thing about the TLT is that it's viewed as a safe alternatives to stocks. So when we see like this strong surge here in the TLT, that's a bearish signal. And if you look here at accumulation distribution, you see that we reached a new high now on the weekly data points. And here on the dailies, I mean, it's been this is a very strong rally. I mean, there's obviously a lot of money that's gone into the TLT, so that is definitively something to keep our eye on. And the next market to look at, let's look at gold. I prefer to look at the gold futures. So when it comes to gold, it became a bit messy because we did have this very nice thing here with the blue 100-week moving average. So it's been support for quite some time, and we usually get a big rally. Well, I think a decent rally. The problem is that first we got into like clear resistance here from the green 50-week moving average. And now the blue 100-week moving average has become a resistance. So the situation here for gold is just very noisy. We still have this super gargantuan cup and handle pattern in development, which is long-term a bullish pattern. However, because we lost this clean, nice support level, the travel upwards, assuming we go up, it's going to become just more noisy because now we have another resistance level to contend with. So it is what it is. Looking here at the daily data points. So here you can see that the 200-day moving average here in red, it's a very clear resistance level, and that one is it's going to make the trip for the bulls more noisy. The long-term correlation between gold and the S&P 500 is 64-ish% positive. Short-term correlation is minus 28%. So you do have that, it's far from perfectly inverse. If we had like minus 90%, like if we go back here as an example, here we have, and this was March 2021. Here we have a minus 78% negative correlation between gold and the S&P 500. So at that point, you could certainly make a case that they do move opposite each other. But when we have this minus 28% correlation, it means that sure there is a negative correlation, but it's not. You can't say that they move opposite each other. They just clearly don't. What we do, however, see is that you see that the correlation here has gone from being positive to now becoming more and more negative. Because you see that over time the correlation has sort of moved kind of smoothly. So it could be that the correlation becomes more negative. If so, we do get that negative correlation, more clearly negative correlation, then that could be beneficial then for gold if we do see some breakdown on the S&P 500, because then you will have this very clear negative relationship where gold actually do work as a hedge against downside on the S&P. So that's gold. Let's go to Bitcoin, another key market. We start with the weekly data points. So we did have this, because I was very critical of this move here because it happened very, very quickly. And you had the major risk of a double top. And we have certainly seen that, the bulls were not able to push it higher. So this is just unfortunate. But there is, a but here. It is fully possible that this test we had of the green 50-week moving average, that it was like at least a momentary low, and that we will be able to rally from that. We definitively do not want to see the green 50-week fail because it's been important ever since this sell-off. So it's a huge, huge, huge deal. When we go here to the daily data points, the 200-day moving average here is very psychologically important. So hopefully it will play itself out, in a bullish way. When we look here at, the seasonality, for this month, this is December, you do see here that for the S&P 500, it does close 65% of the time higher. The problem for the S&P is that January is the weakest month, and that's, the next month, of course. When we go here to the gold, you do see that it's a bit of quite different because December is it's one of the stronger months, and then January is it is the strongest month. So that is definitively very interesting for the case of for gold. When we go here to the TLT, the 20-year Treasury bonds, so it closed. December is 50-50, and January is also pretty close to be like a 50-50 month. For the bulls and the bears. So no one has a really clear edge. For Bitcoin, December it closes higher 50% of the time, but the average gain is 12.4%. Then January is a very weak month, and February is very strong. So let's quickly look at some other key markets. So here we have the WIX, definitively seeing a huge rally here. If we go here to the daily data points, so let's look a bit at some of the. So what is the probability, directionally? So if we zoom back a bit here, looking at the RSI and the PPOs, we are at a pretty high level. So based on the history going back here to after the lockdown plunge, we are definitively at a very high end of the WIX range, which means that if this goes higher, and then we basically have to look back to this, the big lockdown plunge, and that would obviously, be very bad for the S&P and other, risk assets. However, if this recent move in the WIX was just part of, a bit of a correction, and that is what we have seen so far, at least in terms of the S&P, then the expectation would be that we would see then a pullback in the WIX. The key thing here is that the market is really at this major standoff between the bulls and the bears, because as we saw, there is this internal breakdown. There's certainly something happening when it comes to the sub sectors and industries. Many megatrends. Key stocks among them, even though they have pulled back a lot, they are undervalued, they have strong seasonality, they break down. So there's obviously this panic that underlying this market that could become something more profound. So let's quickly look at crude oil here. I think it's T. Out here with the weekly data points. Yeah, we do actually have a break here of the green 50-week moving average. You see that back here it was a key as a resistance level. So it definitively is a moving average that one would assume would be relevant. Here we have the red 200-day moving average. You see that when we go back here, it was sliced and diced a bit. Here we didn't have a clean test, so the 200-day moving average, it is important, but you see that we don't have that much, surgical interaction when it comes to crude oil. And that is a key thing to look at when studying technical indicators. You have to look at, the history of the security in question and ask yourself whether it has a clear interaction with said moving average or other indicator, because that is how you can gauge the tradability of that moving average or whatever you are looking at. And that is one of the reasons, that is the reasons why when you do this big data analysis of technical indicators, you will see that they usually don't work. But that is sort of missing the point, because certain types of indicators work for certain securities. It's just that you have to find the indicators that work the best. And then you just have to look at the chart and look at the history of the interaction between price and said indicator. Is it reliable for bullish or bearish signals or not? And in this case here, illustrative example with crude oil, you saw it didn't have a very clean interaction with those moving averages, which means that the reliability then goes down. So yeah, if you look here at the megatrends, you see that even though the average performance from the low is massively outperforming the S&P 500, still we do see here that when it comes to the average here from the 52-week high, it is minus 43%. So there definitively are these ninja bears out there. notwithstanding that these are very strong trends, does space exploration have a future? Of course it does. Is Alzheimer's a huge topic? Is it going to become a bigger topic going forward? Is it a strong megatrend? It certainly is. But we have seen a minus 65% average pullback. Same thing with biometrics here. So yeah, there certainly is something happening. So yes, there are definitively bears out there. They are ninja bears, they are stealthy, and they have been assassinating a lot of bullish stocks, industries, sectors, natural resources, you name it. So the big question is, will the next target then be the major indexes? Because I like to compare, the battle between the bulls and the bears to warfare. And it's sort of like, you have the ninja bears now. They have been assassinating gradually and stealthily the key generals on the bullish team. So one after another, they are just disappearing. And the big question, will they be able to sneak into the headquarters of the bull camp, and take out the S&P, to take out the Nasdaq, take out these super key indexes. Okay, so the thing is that I am working on this subscription research service. And I'm going to make it, way more educational. It currently is closed for new members. That is simply because the people who are currently subscribing, they sort of understand what I'm altering, I'm changing. But I think that I just want to make all the changes until I open it up so that there's no confusion. But the key difference here is that I'm going to make it way more educational. Because I make these videos on YouTube and these other platforms, but I do know that as I have developed, in terms of my understanding of the market, there is an elevated complexity in the videos I make. So I think that because of that, it's a high time for me to make more educational material. So what I am making, that is these different courses that I'm putting on Teachable. I have one working on a friendly introduction to investing, and you see that here is like a list of all kinds of topics I will explore. Then themes shaping our future, going to the major big picture cycles and also the megatrends. Then Zen investing psychology, going into all kinds of psychological phenomena, logical fallacies, emotions, and also working on this alpha investing course, the power of money from sticks to cryptos, and one on options and other derivatives. The thing is that all of these courses and other content that I will have behind the paywall, it will be available at a very reasonable price. Now I'm considering keeping it at $19, monthly, and that is actually very generous. You will be able to get this entire Excel file as part of the package and a bunch of other stuff. This Excel file alone, with all the content I have here, categorizing these stocks under these themes and all of that, that alone is very, very, very valuable. And the total value of what I am going to just push out there is just going to go up substantially. So yeah, I think that is the best direction forward. Simply because people are at different stages, and as you learn more and more about the market, it is very easy to forget where you came from. So I am very impressed by the average intelligence of the people who subscribe to the paid servers, and also those who are watching the free content on these various video platforms. So that is what I want. I want the big brains to be part of the whole DiamondArm thing, and looking longer term as I develop it, as far as recruiting people and stuff like that, that will definitively be from the pool of those who take the courses. So have a great week ahead, and stay tuned for all kinds of awesome stuff in the future.